Okay, let's get some opinion in straight up. Rajeev Agrawal, Managing Partner and Fund Manager at DoorDarshi India Fund, and Arvind Sanger, Managing Partner at Geosphere Capital, are joining us to run us through all that has happened and what they see, the impact here. Gentlemen, good morning. Good to have both of you here. Arvind, we've not had one of those big days like we had on Friday in a while. So first, your sense, is the reaction in the US itself a bit of a overreaction? I mean, is this too much extrapolation going on, and will things settle down there before we talk about the implications here? Arvind, go on.
Well, I would say, it's interesting that the market had a huge run-up prior to this shock. So I would say the market PE is still 29 times on the S&P. An overreaction would be if the market had gotten very cheap because of that. All it's gone from is very expensive to somewhat expensive. So, I think we get into this recency bias, right? That whatever the market was at the high a couple of weeks ago is the right number, and anything that comes off that is a big correction. My point is the market was on this optimistic high, that we were having this perfect soft landing. Everything was hunky-dory. Inflation is defeated. Fed is cutting rates, and the market went bananas over the last several weeks, months. And what has just come back is some recognition, not a certainty, but some recognition that the probability of a recession has gone up. So the market has corrected, but not corrected to a level where you could say, wow, we've already discounted all the bad news. We're just starting to recognize that maybe the risk is two-sided and it's not just a one-way street. And so in that sense, I think, I don't think it was an overreaction. I think it was overdue. I think there was too much optimism. And the risk of a recession is real. I don't think it's a certainty, but it's certainly a reasonably good probability that we could dim it to a recession.
Arvind, the second quarter GDP numbers just came out in the US, right? You have quarterly earnings. I mean, these are two data points which I can think of, which kind of a recession two questions. One, do you think we will see a recession? Some are saying we already are in one, right? And second, what kind of a recession? We had a recession back in 22, a technical recession. Markets barely did react in a big way at all. It just sort of carried on. Unless you get a profits recession, do you think it'll do real damage?
Well, so let me just go through the companies that reported negative consumer demand. McDonald's, Hershey's, Kraft Heinz, Amazon. This is a very broad cross-section of companies that are seeing consumer sentiment and consumer spending slowing down. This is not, some small subsector of the economy. So I think, if you're not in a recession, the probability of a recession starting in the fourth quarter is probably at least 50-50. And I don't think the market's discounting that, but that's my personal view. Time will tell whether that turns out to be true or not, but we're seeing a lot of signs of consumer starting to weaken. Now, you're right. June quarter, consumer demand hadn't yet slowed down as much as it has now, or maybe it started at the end of June. But some of these companies are reporting in June quarter that they already started to see disappointment. So I think that these things, we don't have a recession till we have a recession. It doesn't come with a warning label, neatly labeled that second quarter was strong, therefore third quarter can be a recession or fourth quarter can be a recession. So I don't know. My view is that the risks have gone up.
Sure, and that's really reflecting in the way asset prices have moved in the last couple of days. Got that. Let's bring in Rajeev into the conversation as well. Rajeev, what's compounding the situation and the complexities? What's happening in Japan, right? Because now I don't know if you could hear the call made by Jefferies just a while back. For instance, Jefferies is saying that we could get an intra-meeting cut. The Fed could realize that they've been late and maybe they don't even wait till September. So that's what's happening in the US. In Japan, you've got rates going up and you have this surging yen situation. And that's where I think we realize we all are reminded that the money flows are interlinked between such large markets. What do you make of this whole situation with the yen carry trade, and what could we be looking at in the near future as some of this unravels?
I think it's very interesting. Most of the time, the central bankers move together. And after a long time, we are seeing that Japan and US are possibly on a different course. I think just coming back to the US and this talk about the intra-meeting cut, definitely it is gaining a lot of ground from what I see here. And I was on your call earlier hearing what Jefferies Chris Wood said. And so it does seem like there is the risk of negative events has increased the probability that the Fed will move. Now, whether the Fed does a 50 basis point cut in the September meeting or they do a pre-meeting cut will tell us much more about how they are thinking. So I think that's on the Fed side. But on the Japan side, clearly the yen was weakening very aggressively in the first 6 months. And only in the last few days, we have seen a significant strengthening of the yen. I think these cross currents will play out. Clearly, the geopolitics is only adding, making the whole thing much more murkier. So I don't think there is a clear view. I personally think this is a time for us to be watchful and take actions only when something looks really compelling.
Okay, all right. Hi, Rajeev. Hi, Arvind. Good morning and good to see you. And Rajeev, you've been investing in various stocks and normally you name, a few of them as well. Suppose we see a pullback, on the headline index itself, a couple of percentage here in India itself. Where all will you be looking to buy? You've mentioned in the past that private banks is something you like, select NBFCs as well. So what would be the top 2-3 ideas that you'll be looking at?
Yeah, Nigel, great to be on your call again. So I think the ideas have not really changed too much from last time because frankly, if you think about the banking sector, or the NBFC sector, those are still where there are some value plays out there. But beyond that, as we know that the market has been on a one-way street, just given the liquidity that we are seeing in the market. And therefore, it remains to be seen how much of a pullback we get here. But I think those names which we have talked about in the past possibly still may give us some value if there's a pullback.
Arvind, let's come to India here and now. Till now, this market, as to borrow a phrase from Prashant, it's been Teflon coated, really, right? You throw anything at it and the market bounces in a matter of a day or two. Not sure if it's going to be different this time or not. Your thoughts and whether you still advise buying every dip here?
Well, I agree with what Rajeev just said. I would be patient. I don't believe any market is bulletproof. If investors think any market is bulletproof, unfortunately, they might learn the lesson the hard way that a global, economic risk-off, there are no places you can, hide. But within markets and within India, there are sectors that are less susceptible. Look, things like, chemicals, metals, IT, a lot of these sectors are dependent on global factors. So you can't go hide in those sectors and say India is not going to be affected by what happens. But if you look at the financial sector, the leading private sector, high quality banks, or you look at some, infrastructure, power related domestic facing companies, that's where you should find places where the growth story should be largely unaffected by what happens. But, the Indian market is made up of companies that serve a variety of sectors. IT is obviously a big part, petrochemical, chemical. There are many sectors that are definitely not immune to what happens globally. So I think one has to distinguish between global risk-off and sectors in India which should be largely unimpacted by this.
Okay, all right. Rajeev, before we wind up, I wanted your comment as well. Warren Buffett's selling 50% of its holding in Apple. How do you read that?
Yeah, I think that's a very, very good telltale sign for us that obviously Warren is worried about what is going on in the markets broadly. But clearly, Apple at current valuations is not cheap. Its iPhone franchise has not grown as much. So I think Warren has been able to take good advantage of the current prices and reduce it quite dramatically. I mean, look at his cash position, $277 billion, right? So he really has the firepower to take advantage should there be a pullback. And that is why he's Warren.
Absolutely. Gentlemen, we'll chat more. Thank you very much for joining us for now. Appreciate you coming on, Rajeev and Arvind. Good speaking as always.